Hello, good morning, everybody. I think everybody would like to know how to survive in the volatile stock market. And I think one of the best tools we can rely on is according to this book by Jeremy Siegel, so-called Stocks for the Long Run. Okay, and now let's try to see this simple tool, and yet that's a good weapon for that. The so-called 200-day moving average. And in the next figure, I will show you the way the 200-day moving averages to the Dow Jones Industrial Average in the two periods when there has a heavy, a deep retracement or it's a kind of crashes, okay, and how you survive from that. In this year, there's a free fall, and also we happen lately around the financial crisis in 2009, between 2008 and 2009, and now we have the coronavirus also a crisis here. So if we follow this simple tool, the 200-day moving average, you quit at this here, and you quit here, then you can survive from these crashes. And also, it is equally true in the last coronavirus crash. When the price returns above the 200-day moving average, then we can then re-enter. And if we re-entered after 2009, around the middle of 2009, and the recent history, you have a very, very good 10-year bull market, and that you have earned a lot from the stock market, of course, and you can quit also during the last coronavirus crash. Okay, now let's look at the daily chart of the Dow Jones Industrial Average over the several years. If you look at that 200-day moving average and keep your investment all here, and there are certain whipsaws, of course, then you have to actually wait for a little while before you quit, of course. But that here, for sure, the prices were below the 200-day moving average, and you should be out of market during that period, around 2018 October, and back to the market 2009 February. And of course, there's also some whipsaws there. But here is very critical. When the price fell sharply below the moving average in the period starting with March of this year, then you should quit the market and wait until the prices returned to above the moving average. Of course, that you will miss the opportunity there, but that is very dangerous if you invest now here to buy the stocks because the price may fall again. But it's not any kind of guessing, because as the book mentioned, it's a kind of tool and you must rely on that as a system. It's not 100% guaranteed, but at least we have something to rely on. Okay, it's better to be late than to be unsafe, of course. Okay, so we keep an eye on this very important indicator, 200-day moving average. Thank you for listening.